Hi, I'm Justin Kuntz, Managing Director of Pacific Wealth Management. We just released our latest market commentary summarizing what happened in the financial markets and the economy in 2024, as well as what we expect to happen in 2025. We wanted to take a closer look at a few different charts from Ned Davis Research, one of the research organizations that we utilize to make investment decisions here at Pacific Wealth Management. By taking a look at these charts in particular, it gives you a glimpse as to what kind of happened under the covers in 2024, and then we'll dive into what we expect in 25 from here. This first chart that we're going to take a look at gives you an idea as to how good of a year it was last year. The economy did much better than expected across the board, and the market reflected that. This chart shows you the S&P 500 in the top clip relative to two different substantial data points. The orange line shows us what GDP relative to potential GDP looks like. So GDP is a measure of economic output within the United States. If the orange line is in positive territory in this chart or above zero, it's basically showing that our GDP or economic output was above what most economists expected as far as our potential for economic output within that year. When it's in negative territory, that implies that we're doing worse than expected. The hash line is a reading on CPI or inflation. So when the hash line is above zero, that indicates that it is above trend or inflation is higher than what we've experienced in the last 5 years. When that hash line is in negative territory, the opposite. Basically, inflation is below where it's been in the last 5 years or below trend. If you look particularly at what's happened within the last year, you can see why 2024 was so productive and the market, in the top clip, performed so well. Inflation, that hashed line that I was referencing earlier, is in negative territory, implying that inflation was lower than what we've experienced in the last couple of years or below trend. That's a positive economic tailwind. And then you also have our economic output in orange, or real GDP relative to potential GDP, in positive territory. So we did better than expected economically, and inflation was coming down. That translated into a Goldilocks scenario for markets, and one in which Wall Street took full advantage of and ran with. As I talked about, part of the reason why last year was so good is the inflation dynamic decreasing throughout the year. Inflation is made up of a lot of different factors, so I wanted to dive into a chart that kind of breaks that out and shows you what's happened over the course of the last few years with inflation and why it was such a good scenario in 2024. This chart breaks down three different categories of inflation. The solid blue line you can think of as goods, as opposed to goods and services. Goods are things that you buy. In this case, it does not include things like food or gas or electricity to power your home, but everything else in that goods category. The hashed orange line represents shelter. So think of that as rent, mortgage for your home, that sort of thing. The gray hash line is services. So you hire somebody to paint your house, hire somebody to work through your business, or you go to a restaurant, everybody working at a restaurant. That qualifies as service-oriented inflation. If you focus on the right-hand side of the chart, you can see a big spike as a result of COVID. That was that spike in inflation across almost every category that we all witnessed. And then a drop-off in the last, call it, year and a half, 2 years. Particularly in the shelter and services category, you can see how strongly that came down recently. And while prices are still going up, inflation is still happening. Disinflation is what we witnessed last year, where the level of price increases was going down. The rate of change was decreasing. So while prices were still going up, they were going up at a lower rate. Now, when it comes to goods, if you look at the solid blue line, that's actually in the category of deflation, where prices were actually coming down for the first time in a little while. So that was good to see. All of these things were tailwinds for the economy, and ultimately was the main driver of the bull market remaining in place through 2024. Another big driver for stock market performance in 2024 was the concentration of just a few stocks that basically led the way. You may have heard about the Mag 7 or the Magnificent 7, primarily technology stocks that did so well last year and have done, frankly, quite well over the last couple of years. However, part of the reason that they did so well was what happened with their earnings. A lot of it surpassed expectations. And in this chart that we'll take a look at here, we'll break that down a little bit more. So in this chart, we show what's happening within the Mag 7 stocks, those 7 top companies in the S&P 500, relative to the rest of the S&P 500. On the top clip, it's on a trailing basis, so what's happened in the past relative to year-over-year growth. And on the bottom clip, it's the forward earnings expectation, so what is expected to happen from here. Now, what you can tell is in 2024, you can see that separation between the blue line and the orange line in both clips, top and bottom. What that's implying is that the earnings growth for those Mag 7 companies was substantially higher than what happened with the rest of the market. The rest of the 493 companies in the S&P 500, earnings per share was virtually flat throughout 2024. But for the Mag 7 companies, greater than 50% earnings per share growth. And on the forward-looking side of things, it was also substantially higher, closer to between 50 and 40%, whereas the rest of the market was just hovering around 5% expected EPS growth. So that was part of the reason for the substantial outperformance with those companies. And what it allowed them to do was invest billions of dollars into artificial intelligence technology and return billions of dollars back to shareholders with dividends and buybacks and a lot of other dynamics. So that was a big tailwind for markets. And the fact that the S&P 500 is what we call a cap-weighted index, where the larger companies have that much more influence over the rest of the market as a whole because they're so large, they drag the rest of the market up with them. Now, while the concentration of the Mag 7 within the marketplace as a whole was a positive for markets' performance last year, there are some reasons for concerns, and I want to highlight where we stand today relative to history to kind of show you a bit more about why that is a concern and something worth paying attention to. In this chart, I'd like to focus on the bottom clip in orange, where you can see the top 10 stocks in the S&P 500 as a percentage of the total. So when that orange line is in elevated territory or higher, that basically represents a period of time in which there is substantial concentration where those top 10 stocks represent a larger share of the market as a whole. If you look at what's happened recently on the far right-hand side, you can see that we're pretty much at record highs. We're higher than we've ever been. Nearly 38 to 40% of the market share is held by the top 10 companies within the S&P 500. If you look back in history to gain some perspective, you can see what other peaks in this concentration graph have brought for markets. If you go to around 2000 in the middle of the chart, you can see when we kind of approached almost 28% of market concentration. That was the dot-com bubble. You may have heard of that bubble and burst. And you can see what happened with the market in the chart above that. Back in the 70s, there was a period of time where that concentration existed again. It was called the Nifty 50, where there was a fair amount of concentration within 50 companies at the top. As you can see, once again, that led to market underperformance in the next few years in this S&P 500. So it's not to suggest that the market is headed towards a big decline as a result of this situation. However, it's something that we should be aware of and ultimately does bring volatility to markets in most cases. And that dynamic is important to keep in mind when thinking about where we stand today relative to history. So this next chart highlights that even more. Let's take a look. When thinking about dynamics in the stock market that bring about volatility, one aspect is what's happened in the year or two prior. Whenever you see markets that have performed pretty strongly in a consistent way, it generally brings about volatility in the years following. This chart shows what's happened with the S&P 500 relative to the amount of record highs that the S&P 500 posted during that year. As you can see from the chart on the bottom clip, 2024 brought a fair amount of record highs, actually 57 over the course of the year. That is the sixth most amount of record highs posted in a single year since 1928. And to that end, if you look at the data around those years in which a number of record highs were reached, you can see what's happened in the following year. On average, markets have returned negative 3%. The median return in all of those years following record high numbers was negative 6.2%. Only 28% of the time were markets positive after a year like that. And on the topic of concentration, the recent run-up in the stock market has definitely changed what many Americans' balance sheet looks like. Stocks now represent a much larger share of everyone's net worth than it did in years prior. This chart shows you stocks as a percentage of total financial assets for households and personal trusts. And as you can tell on the far right-hand side of the chart, in the years that we've recently experienced, we're at the higher end of the range. Stocks now represent a record 36% of financial assets for households and trusts. That represents some challenges in itself, because that concentration means that what happens in the stock market substantially influences the wealth of individual households. With all that being said, it's important to consider all of these different dynamics when thinking about what will happen in 2025. We should be faced with a number of unique challenges this year when it comes to inflation, interest rates, geopolitics, and also political change within the United States. Let's take a look at where we stand today relative to interest rates and what that might mean for the economy moving forward. This chart breaks down the S&P 500's performance on average during a rate cutting cycle. So when the Federal Reserve Bank begins to reduce interest rates. The black line represents an average of all cutting scenarios. The dark blue line at the top represents slow cutting cycles. The orange line, fast cutting cycles. The green line, non-cycles, or situations in which the Fed did not cut rates. And the lighter blue line, the current market trajectory and what's happened thus far. The middle clip is essentially what you can think of happening within the first year from the first rate cut happening. And ultimately, the data tells us in this chart that under slow cutting scenarios, the market tends to perform the best. So if the Fed is patient in their efforts to cut interest rates, that should mean the market will perform relatively well. However, if you can contrast that with what happens during fast cutting cycles, or the orange line, it's a little bit of a rockier road. If you think about the context around a fast cutting cycle, usually the Fed is cutting interest rates quickly because they have to, because they're trying to rescue the economy from an upcoming recession or a shock to the system of some kind. So generally, the stock market doesn't perform that well during those scenarios, and that kind of blends into why you see that separation of performance between slow and fast cycles. Right now, the performance of the market is tracking that slow cycle pretty darn well. You can see, we're 3 months in to the first cut, and things are tracking well. But it remains to be seen what the Fed will do from here. So we'll have to just wait and see. The other dynamic we have to consider is what happens in the first year post-election year. We're in 2025. We are under a new administration in Washington. Let's take a look at what the data tells us around the first, second, third, and fourth year of new administrations. This chart shows what the S&P 500 does on average during a 4-year presidential cycle. We're currently in the first year, 2025. What we expect to happen based upon the S&P 500's average performance is that the back half of year number 1 in a 4-year cycle tends to be a little challenging. Markets tend to rally on the new administration's promises for change and whatever they may bring. However, generally that excitement wears off in the back half of the year, and usually markets suffer as a result. If you look into year 2, that trend kind of continues. Year 2 on average is a tougher one. However, Year 3, year 4 tend to be met with positive returns. You could say that the administration gets into their stride, and the Wall Street becomes a little more comfortable with that administration and what to expect, and therefore performs relatively well on average. As I previously mentioned, inflation is a big piece of this puzzle. What happens there will be a big driver of what happens to the markets, as well as what happens with the Fed and interest rate policy. If we take a look at a few different models from Ned Davis that show where to enter and exit the market based upon inflation, it gives us an idea as what trends to look out for given the current circumstance. This chart shows us what the S&P 500 has done relative to CPI year-over-year change, or the pace of change within CPI. The hashed line within that bottom clip simply is a smoothing of that CPI year-over-year change data point. When the orange line crosses below the hashed line, that usually means that the markets are in good shape to rally. That's why you see that upward arrow in the top clip align with periods of time in which the orange line passes below the hashed line. That implies that CPI, or the rate of inflation change, is declining, and therefore it's usually a tailwind for markets moving forward. On the flip side, when the orange line crosses above the smooth line, or the hashed line, that's usually a bearish signal for the stock market. It correlates to those downward arrows up top, and ultimately that implies that inflation is ramping up quite quickly. In any event, if the current trend continues, where that hashed line in the bottom and the orange line representing CPI year-over-year change continue to trend downward in a smooth way, we should have strong markets from here. But if inflation ramps up quickly and all of a sudden surprises markets, that could spell some trouble and ultimately dictate potential changes in Fed policy and the market's reaction from there. All in all, there's a lot of reasons for optimism for 2025. The earnings picture across the market looks pretty good. There's quite a lot of positive momentum, and despite the fact that inflation has the ability to potentially derail this rally, at the moment, that data looks pretty good also. So we are optimistic headed into 2025. It's our anticipation that the markets should return positively. However, that can always change at the drop of a hat if something happens internationally quite substantially, or if there's a shock to the system stateside that no one expects. We're keeping our finger on the pulse quite closely along the way, and we'll continue to make adjustments as necessary.